Hi everyone, back again. This next part that I want to talk to you about was in the last video we spoke about basis periods for income tax on commencement and how we work out in years 1, 2 and 3 and then going forward. And that bit is fairly straightforward. However, the next bit, which some people are finding a little bit more complex, is change of accounting period date. Once again, if you hear funny voices in the background, it's because I have classroom assistants with me. 1 and 2 has just gone somewhere else. Please just ignore them. I'm not under attack. So, when we are talking about income tax basis, number 1 is commencement, and number 2 is change of accounting date. So when a business is up and running and it's established and it's past those initial periods of figuring out what the basis dates are, it decides for some reason or another that it would like to move its accounting date and change its year end. Now, the easiest way to look at this is actually to draw a diagram. So, each year runs from the 6th of the 4th to the 5th of the 4th. For each one. Now, if we talk about the question that we did in class for Michelle, originally her accounting date was the 31st of December. Again, I used the green pen, which is rubbish. So, we had got to the point where the 31st of December that was here, we recorded financial statements to this date. Then we move that date to be 31st of May. So in this year, whilst we have a date of the 31st of December, we are not using that date anymore, because somewhere in this period we have decided that we are going to move and we are going to do 31st of May. Now, what we've ended up with is a single period of 17 months. And the financial statements are made for 17 months. You can see that from the dates in the question. So they could have done a short period to the 31st of May in this year. And that would have made it much easier to explain. But a longer period, which tends to be what happens, the main reason being you would have to pay your accountant twice to do a very short set and then a normal set, or just pay them once for the long set. So, in this year, it's fine. We use these financial statements to the 31st of December. By this year, it's fine. We will use the financial statements for this 31st of December. But we have 2 tax years. This one and this one, where we can't do that. So, when we look in the first tax year, there is no set of financial statements that goes to this new accounting date, because it spans it and goes past it. But what we have to record in this year is during this year, the accounting date now is set at the 31st of May. But there's no financial statements for that date. But also there is no financial statements to the 31st of December. So when we come to do this year, we must do the 12 months of trade to this date. Now, that is that period. And that is partly on these financial statements and partly on these financial statements. Now, So, When we look at this period, which we're trying to do, we have 7 months here and 5 months here. So we will do 7/12 of the last set of financial statements to the 31st of December. And then we will take 5 months from this period. Now, you just have to be careful because many people, it just trips off the tongue, well, that's 5/12. But this set of financial statements is not 12 months long. It's 17 months long. So it becomes 5/17. And it's very quick to see that this is an overlap period because these 7 months were already on this set of financial statements in this year. So the difficult year is the year in which the date changes, the first year that it changes, which isn't necessarily the first year which accounts are made up to the new date, because in this instance, the first set of accounts for the new date were in this year. So this becomes our overlap. This is what we record in this year. When we move forward to this second year, now we have a set of financial statements that finish in the year to the new accounting date. But they are not 12 months long. They are 17 months long. So we only need this 12-month period. So it is 12/17 of the financial statements. And as you can see, this 17-month period, 5 months is here and 12 months is here. There is no overlap there. They go against each other rather than going over on the dates. So there is no more overlap period. That's how you calculate the profits that go in those two accounting periods. But there is one more thing which we can claim now. We can only generate overlap profits on commencement or on change of accounting date. This is on change of accounting date, and we've got an overlap period here of 7 months. That bit's easy to see. But because we have generated new overlap profits, we are eligible to claim overlap relief. Now, overlap relief is the use of previous overlap profits as a deduction. So in this question, we had 1 month overlap from the second year. We had 2 months overlap from the third year. So on commencement, we generated 3 months of overlap profits. Now, because we're generating overlap profits from a change of accounting period, we can claim overlap relief, which is where we can reduce these 3 months off of our profit. Because this is 7, obviously it's more than 3 because the relief is time-based, we can use all of it. So the 13,152, which we calculated as the overlap profits, we can take that off of these profits. It doesn't, however, mean we can use these 7 months. These 7 months carry forward. So the 7 months, which are 51,800 times 7 over 12, which was 30217, that is then the overlap profits carried forward, which we could then use again if we have another change of accounting period or if we close. On the closure of business, any previously unrelieved overlap profits are taken off. So when we're doing this year, we need the 2 periods to add together for the profits. Then we need to measure this overlap against previous overlaps. And because it's more, we can take overlap relief of the whole amount. And then we can do whatever this is minus the overlap profits from before so that it reduces it. This is the most complex part of income tax basis periods. The commencement isn't specifically, I hate that word, specifically difficult. Change of accounting date is more complex. It is more involved because we're figuring out what's happened before and we've got more overlap profits and we can claim overlap relief. Try to use this video and the previous video as a guide for working through the 2 questions that we had and also the answers for them as well. I will upload a couple more questions later this week for you to work through on this topic as well, but that isn't the topic for this week. This week's topic is inheritance tax. So I will upload this video into last week's, and then we will have 2 new videos and 2 new questions, one of which is the exam question from last year, so you can see and know that it's at the right standard and the right level, and we'll work through those. The questions and the answers will be on Nile, as will the videos showing me go through them again. Okay, I'll see you soon. Take care, stay safe.